Hello and welcome everyone to today's session regarding deep dive with the markets. My name is Mohammed Shanti and I am a financial market analyst at EGM Securities and FX Pesa, and I will be your host today for this session. It's a very short session, 30 minutes session, and we will be talking about different stuff. But for today's session, we will mainly focus on giving you a strategy. I know that you guys love trading using your phones, and I know that you love scalping and trading within like the 5-minute charts and even the 15-minute charts. So just before going to that strategy, I will be talking in a brief on what's going on in the markets. In general, as you know, both the precious metals commodities are going down amid peaceful talks between Ukraine and Russia. Even though there is still a war between them, yet the talks actually hindered the rally that was happening for gold and even for the commodities. If you look here, this is the 1-hour chart at the precious metal, and you can see the prices of gold is standing at the levels of 1928, and it was like 1 week ago almost at 2070. That's like almost 70 and almost $140. And this drop was mainly due because of two things. One of them is a lot of traders are going for the US dollar amid rising treasury yields, and also because we have the FOMC numbers coming this Wednesday, like tomorrow, and there's expectations that the interest rate will be risen or hiked by 25 basis points. This is not good for gold, and that's why gold is going down at the moment. Another reason why people are going for dollar more is that because there is some fears, but not that great, because they are traders are basically betting that the effect of the Russian-Ukrainian war on the global economy is not as big as they feared. However, the imposition of bans from the US on the Russian exports, or oil exports, actually affected oil prices. So in general, let's talk about the technical setup for each one of the items that we'll be talking here, starting with precious metal. And as you can see, precious metal is doing a small retracement on the daily chart, as you can see here. But if you look at the 1-hour chart, it's standing below the simple moving averages. And as you can see, negative territory here. It was in the oversold area from the stochastic. Now, as you can see, there was multiple crosses to the downside, and from the MACD, you can tell that there is a bearish control. So what do we do for what can we expect from gold in the coming sessions? Basically, prices must go back above this dynamic support, which is the simple moving average of 200 and smooth moving average. And if the price go all the way above the 1943, we could expect prices to range between these two simple moving averages. Now, as long as prices staying below this dynamic resistance, we could expect continuation in the bearish side. Now, nonetheless, our retracement above this level, we could see a continuation for the daily chart. So what's going on is that like it's going a breach of an important resistance level, and then going all the way higher and higher, almost to the all-time highs of 2074, already achieved during the pandemic, but it's barely reached that, almost a little bit shy from that level, which is 2070 now, before, and now it's retracing back. Now, there could be a take profit position happening from people who actually took a trade from this area, and they are gaining. They are out of that trades, but still, if prices retraced and continued its bullish momentum, this level must be defeated, which is the 1974 for the long-term view. If prices retraced back to the 1974, we could see a continuation to the upside. However, the main take profit levels will be the latest highs of 2070. From the downside, a confirmation of an end for this bullish trend in the daily chart would be this level, which is 1886, which will be in the hourly chart the main take profit levels for them. So 1886, that's the main levels for sellers. And as long as they project, let's say, if as long as they were able to keep pushing prices below this level, which is 1942, expect prices to reach all the way to 1886. Now, how can we benefit from that? I'm going to show you with this simple strategy, and you can apply it very easily on your phones and even in your laptops. Going for the oil, US oil, and as you can see, the US oil was almost was almost 126 almost 2 weeks ago, 10 days ago, and now it's retracing all the way down and down below the simple moving averages, and also the MACD confirmed that situation. So therefore, it's similar story to oil. We need prices to go back above the 110, especially the 100, to see a continuation to the upside. If you look at it at the daily, similar story, however, it's with a little bit bigger wicks. So we could expect prices to retrace back if they were able to stay above the 93 level. However, prices must go back all the way above the 100 in order to see a continuation to the upside. For the euro dollar, as you can, we've mentioned last time that these are the main levels to watch for in the coming days. And basically, it actually tried to defeat the one spot 1046 before, and it did, but it retraced back again. And this resistance, this support line is still not being defeated. So basically, we are seeing a small range trading between these two prices. And now we could expect prices to go back all the way to the one spot 1046. If we look at the 1 hourly chart, let's remove these so we can see a little bit clearer view. Now, this is the main level that I've talked about from the downside. So sellers should aim for this level, which is one spot 08. And at the feet of this level, we could see a continuation to the downside. But however, till now, prices are still trading within these dynamic moving averages. And now prices are going a little bit down, almost to the oversold territory. However, there is a bearish crossover above the zero line, which could indicate a reversal for this small uptrend that happened before. So prices were able to go lower, and then there was a bullish reversal signal from this area, and it happened. And now it says that maybe a continuation to the downside could continue. So a high, a lower high, another lower high. We need this level to be defeated. What is this level? Basically, we need to have arrow over here, 1.0890 or 1.09. At the feet of this level, we could see prices all the way down. So as long as this level being intact, we could see prices continue to range. That's in the short term, a little bit short term view. For the Dow Jones Index, it's a different story. As you can see, the prices are literally ranging. So ranging within a bigger, let's say within a bigger range, not a very small range, but still they are ranging. You can see almost triple highs, 1, 2, 3, and this is fourth. And there are multiple lows, 1, 2, 3, 4. So this is a crucial support area, and also crucial resistance area. So prices either must defeat this dynamic support, which is at, let's have an arrow so we can see, 33,500. It is required to be defeated in order to break this narrow range. At the feet of this level, we could see like a bullish momentum to the upside. Now, if prices retrace back, we could aim to this support area, which is 32,700 or 32,800 area. So that's quite a range. So we can actually exploit it in our technical setup, especially in the 15-minute chart. So what we can do is that if on the hourly chart prices retrace back from here, we go for the 15-minute chart and then try to find a bearish setup such as this one, for instance, this one. An indication. If you look here at the MACD, there was a bear signal. Also, there was a crossover just 2 candles before from the stochastic. So here could be an entry. We can take it and aim for this area. This is a very short scalping, basically, and from it we can take profits. Another trade we can look for is, if you look at the pound, for instance, pound, similar story to the euro. Not similar story. However, it is still bearish similar to the euro, but not as the euro, because the euro we saw a small retracement to the upside, a bigger retracement than this, and now we are seeing almost a formation of a rally to the downside. we need this price to be defeated, which is almost 1.3. At defeat of this level, we could expect prices to go down. However, the MACD is going higher above the zero mark, which indicates maybe bulls are in control now, and we need prices to go all the way higher above this level, which is 1.3125, in order to confirm the bullish setup. Now, if this level were defeated, the main dynamic level that bullers could aim for could be this one, which is 1.3247. A defeat of this level first, which is this one, 1.3131, means that prices could go all the way to the 1.3247. I know there is a near resistance level over here, but that could be confirmed, that could be defeated easily if prices continued with a really strong momentum to the upside. So as long as they defeat this level first, this could be easily handled. Now, if we want to look at any trading strategy that we want to take in the very short term, I suggest that you use technical indicators. Now, in your setup, in your phones, or even in your MT4, we can actually add simple trading, technical indicators in your trading, and you can use it to exploit the market. So let me give you an example. So let's start with a naked chart over here, and let's go with gold, so you can see how this setup works. First of all, you need to add the first indicator that you need to add is the Ichimoku. If you go to the navigator or to your insert, go to indicators and then go all the way to the trend, find the Ichimoku Kinkyō. Now, the trick over here is that this indicator has a lot of lines, and what we need to do is we need to clear out some of the lines inside. So if you look at it as it is, it becomes very messy. Now we need to clean it. How do we do that? By going to the colors and turning off the three colors of the green one, the sandy brown, and also the down Kumo, the thistle one, the pinkish one. Turn it off. Once you do that, it becomes much more clearer. So if you look at the candles, you can see it becomes like two simple moving averages. So basically two lines, basically. How do we use that? We don't use them for crosses. We use them for deciding whether to buy or whether to sell in general. So let's start with the red, with the blue one. All right, let's turn off the red and then we're gonna bring it back. So how do you trade using the blue one? Now it's very simple. It's very simple. Whenever prices close above the blue line, you're going to look for bullish entry signals. So if you add, for instance, the MACD, the MACD, okay, if you add that one, every time the MACD gives you a signal to the upside, you take it. So for instance, this one was an entry. So here at this candle, that was an entry point. All right, so you could enter from this area. You might see a small downside. However, the profits were made almost $50 from that area. Similar story, whenever prices close below the blue line, like this candle, we need to find a bearish setup. Originally, the bearish setup was there. There was a cross from this area. However, I was supposed to wait for the candle to close below the blue line. Once it closed, I might enter here. All right. Now that's a really good setup. Now, every time prices close below the blue line, I need to find a bearish setup, a bearish signal, and then enter. Now, if you enter from here, you might get all of that, almost $42. The same story here. It closed above. All right, it closed above. You might enter this area. However, the moment prices went below, you need to go out. This is a short trade, a loss trade, but however, the losses are very small compared to the wins. If you look at this one, and even if you look at that one, for instance, from here, that's way bigger compared to this one, this area over here, because the bullish signal came over here. However, prices were below the indicator, below the blue line. That means That means I can't take this trade just yet. Now, prices went a little bit higher and closed above at this candle. So either I take a trade from here or even from here. However, I need to close it the moment prices go below the blue line. Now, this is a very small loss. However, if you took a selling trade from this area, you might actually get this one, or you might close with almost only a small profit. However, this bearish downtrend continued again over here, and there was a confirmation from this signal at that candle, exactly at this candle, this bullish candle over here. That was your confirmation. Now, the moment prices close above it, it could be your exit. Now, since this line is used as your entry, I'm going to use the red line as your exit. So instead of looking at them as a crossover between them and taking an entry, no, I'd rather take them separately. So what do you need to do? If you add the red line over here, the red one over here. Now, we said previously, we said that was your entry almost here. Yeah. The moment prices close below the red, you get out. So you might got profit over here. Maybe your take profit got hit, or if you didn't have your take profit, you might got your profit over here. Now, if you took a trade from this area, your take profit either got hit or you might have exited around this area, because the moment it closes above the red now, that's a signal to get out. It's not an entry. Use the blue line for an entry and your red line as your exit. So the same way you entered here, the moment it closed below the blue line, I get out the moment it closed above the red line. Same story over here. The moment I entered here, let's say, the moment it closed below at this candle, I get out. All right. Here at this candle over here, when I said here we can enter, look, not even a single candle closed above until this. See, now this is a really huge profit over here. So you can take that, you should have taken that trade and made some profits. So you can use this as a way to enter this market. Another way you can look at it, if you look at, let's go for the oil. Now, if you look at the oil at different dates, so since we don't have the luxury in seeing the future, the moment it gapped up, this is when almost the war was happening. Now, it opened above the blue line. Now I need a bullish signal. It's already a bullish signal from the MACD, right? You can use the stochastic, you can use MACD, you can use whatever two-line cross indicators. So your two-line cross is the indicator that you're going to use to enter. However, you don't take any signal, but rather you take the signals aligned with your blue line. So your blue line over here told us to take a trade over here. We got out pretty soon. However, the moment it gave us another signal at this candle, so here I took a trade, for instance, I take a loss, no problem. However, the moment it gave me another signal over here, that was my another entry. Look what happened. The profits was almost here the moment it closed below the red line. Now, this is a huge profit compared to this small loss. So you would have a very small losses, however, compared with a really big wins. So every time there is a signal, another one over here, exactly over here. So if I got out from this candle, I need to re-enter. When do I re-enter the market? Whenever the MACD gave me another signal. So it gave me at this candle another signal. So another almost a small profit. However, that's $4 on oil. I got out over here. Either I got out here or here. It really depends. Either way, I got small profits. Now, the same situation happened is that This indicator gave me a bearish signal from this area, yeah? However, prices were not below the blue line, so I couldn't take it. So the moment prices went below that, if you look over here, I got a small loss. However, I recovered from that loss over this area exactly at this candle. This candle over here gave me a bullish signal. Prices closed above the blue line, and it never closed below the red line again. If I left my trade, I got a huge gap to the upside. So if I didn't leave my trade over here, I might have left it over here because the red line made sure that I got out soon enough before the small retracement that happened. Now, another trade on oil over here at this candle. At this candle, prices closed above the blue line, this one, or actually this one, this candle. The moment we saw a crossover, it was the next one, sorry. Prices went up again. Now let's see for the bearish side, what's going on lately. Now, if I took a trade over here, I might get out at this candle, almost no win or no loss. However, I might actually enter at this candle later on, exactly here. The moment it closed below the blue line, a bearish crossover, and voila, the magic happened. Now, this is a very simple strategy. However, it disregards a lot of things, such as support and resistance, such as let's say the classical technical setups, such as like the head and shoulders and the wedges and so on. Now, if you try to avoid, if you don't have enough understanding of the let's say the classical technical analysis, adding these two lines alone can actually improve your risk reward ratio and improve your trading in general. All right, there are a lot of trades could be a loss, a small loss. That's why you need to have risk management. That's why you need to have take profit levels. You need to have stop loss levels all the time. So whenever you take a trade, so for instance, if I took a trade somewhere here, I might put my stop loss around this area and aim around these areas. So almost double, almost 1-to-2 ratio. So from here, I got a small win if I have a take profit one, and then another big win if I have a second take profit level. So either way, this bearish trend, it got me all the money that I needed. Now, if you didn't leave at this candle or this one, you might actually left here. The moment it closed above the red, that was your exit. So imagine all of this perhaps for you as a win. Now, here we saw a bullish signal, yeah? A bullish signal exactly. The moment it closed above the blue line, we had a bullish crossover. Even though I know there is a bearish trend happening, in general, a bearish trend happening, this is a retracement. So with your experience, you would know that prices could go down, up a little bit, go down. So you might not actually taking this trade. However, even if you took it, you got out pretty soon with a small loss, very small loss. So this candle, if let's say if I took my trading signal religiously and I entered here, yeah, I would get out the next candle and even entered a short trade at this candle exactly. So the profit over here, like let's say I got out over here, is way bigger compared to the small loss that I had here. So it gives you appropriate risk reward ratio. Now, whenever you see price ranging, for instance, try to avoid using this. Try to avoid using this strategy. Why? Because you will see prices go above and below multiple times. So how can I tell if prices are ranging or not? Whenever the prices are standing between the blue line and the red line, that means there's a possibility for range trading. So this case, can you see? Prices are between the blue line and the red line, and it actually reached a level here and then went down and then up and down. The moment it got out, prices continued its bearish downtrend. So this is another way you can look at it. If you look at the euro dollar, for instance, this is what's going on. So here, the moment we saw a bullish signals from the excuse me, from the MACD, that was over somewhere around here, back away from this area. Okay, let me show you from this area. Yeah, now what do? I wait for prices to close above the blue line. It never closed above the blue line. It did at this candle. Now there is a bullish signal previously. I might have taken a trade from here, got almost 30 pips, and then I closed the trade. Now, since prices are going above and then below, now I can confirm there is a narrow range. The moment it went above it, or let's say closed above it again, I enter a trade. Now the MACD gave me a signal over here exactly. So if you apply it at this candle, taking a trade from this area got me a really big win and actually covered my small loss that happened. If I didn't get out here, I must get out here. Should have gotten out from this candle. Imagine now a bearish signal here exactly at this candle. Now prices went down, got me small profit. If my take profit level didn't hit, I should have exited here at this candle. Now the moment prices went below and above again, range trading. So prices are between the two lines, means prices are ranging. The moment it went back again below it, that was a signal. However, it went back again above it. That means still we're ranging. This is where the support and resistance helps you. Now, since I know this area over here was an important support, okay, I should have waited for a breach, a confirmation. It's called a confirmation signal. So this candle, exactly this candle, gave me a small breach and a small retracement and a wick. I could have entered from this area and aim for a short win. Now, every time prices are standing between the two lines, that means range trading. Whenever there is a range trading, try to avoid using these signals. Always try to look at trending markets. So if you look at USD JPY, for instance, if you look here, we're seeing at the daily chart, there is a huge momentum to the upside. Yeah. If you look at the 1 hour candle, prices actually were ranging, were up all the way. It never closed below the red line, never. So it started from this candle, got me out here, and re-entered somewhere around this area again. So first of all, I got a win from here till here. I got out and then re-enter the market again at this candle over here. It never closed below until here. That's a small win, but again, it gave me another signal from this area again. So it's trending for my side. So the moment I saw this, for instance, this resistance level got breached, I entered from this candle. Now this candle, the prices went up, 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 and never closed below the red line before this candle. So imagine 170 pips on the hourly chart. Now you can apply it on the as low as the 15-minute, and it will help you deeply. Thank you so much for your time. I know I gave you a small trading strategy. If you have any questions, please comment on the YouTube channel. Please subscribe and tune in with us for next week videos. We have a lot of things to share, and thank you so much for your time. Have a good evening. Hello, Tashi. Hi.